Hello, everyone. Welcome to the Emerald Exchange. This is episode 5, and today it is me and Tanya. And
Hi, we have a special guest with us. We've got Tamberyne McCutcheon with Conventus Lending.
our
Hi.
first time bringing a hard money lender on the podcast. We're so excited. Thank you for driving down from Austin today.
Thank you for having me.
So, we were hoping to show the audience a hard money lender's perspective on investing. Obviously, we met you about almost a year ago, approaching a year pretty soon. And since we met you, you've been the go-to for our team, and we've gotten to really build a business together, and we're very thankful we were introduced to you through a mutual client. And I just really want to start off asking you more about your background, what you started in before hard money lending, and what got you to where you're doing now and everything in your business.
Yeah, so definitely. So my career actually started, I want to say when I was 21, when I first purchased my home to get out of my parents' home. And I kind of stumbled upon real estate by mistake. Bought a home, started house hacking actually, just so that I could offset the cost of expenses and so forth. And then that year, I actually got my real estate license. So I actually started in real estate as a real estate agent and kind of pivoted through those years because this is probably like 25 years ago. So with the market changes and so forth, I've been a real estate agent. I've been an investor, primarily doing flips when I first started. Now I'm more buy and hold. So I definitely have a portfolio of mainly long-term rentals, short-term rentals, and midterm rentals. They're in 3 different states. So I have one in Alaska, Washington, and then in Texas as well. And got into lending actually by accident as well. My loan officer that used to fund all my deals with Conventus offered me a job, was like, hey, you're moving to Texas. We actually need someone out there. And I was like, oh, okay. Well, I guess I need a job. And so I started with Conventus 5 years and been a loan officer since then.
Oh, wow. That's a pretty good track record. And so, in the past episodes, we've talked about the way that investors get financing. Some do cash, they have partners, they get private loans. And that's why we brought you on so we could learn a little bit more about the hard money loans.
Yeah, definitely. So, I think everybody kind of starts with not knowing really how to use funding or how to seek out funding. And I was one of those as well because I was a cash buyer when I first started. And what I started noticing is when you're a cash buyer, you're basically using all of your capital. So when you're using all of your capital, you're kind of at the mercy of how quickly your project moves and how quickly it sells. So I would miss out on so many different opportunities because all of my capital was in my project. So when I first started finding hard money, I was like, oh my gosh, I wish I had known about this type of financing earlier because what happens is it allows you to actually invest in multiple projects at a time. So you're not, out of all your capital at once. And then it gives you kind of a safety net as well. Because what I would do is I was a cash buyer. I would work with other partners to kind of offset our money. So we would be, working with like 2 or 3 other partners just so we could kind of bundle all our money in, so we were maybe at the most able to work on 2 projects at a time, but now with hard money, it allows you to focus on 3 or 4 projects at a time if that's what you're trying to scale to do.
Mhm, mhm. And when would you say that an investor should consider hard money only if they're looking to do multiple projects, or should an investor consider buying their property cash because they want to save on all the fees? What's your take on that?
Um, I think it's definitely personal opinion. Like personal, what are your goals? I think, if you are a 1 year type of person project where that's all you can do because you have a W-2 job, or, you can only really handle one project a year and you're able to do that with your capital, I don't say that hard money is for everyone, but it definitely works for a lot of people who are trying to scale. If you're trying to build your portfolio with more rental properties, then I definitely think it helps you in that sense as well. So what that looks like is, people who are long-term investors. So they're looking at not basically getting a whole bunch of money off their first project. Like they're not like just trying to get $40,000, $50,000 off their first project. But what they're trying to do is build a portfolio by buying low. And then in 10 years, 15 years, your equity will build, obviously, because that home will be worth more in about 10 to 15 years. And plus, your tenant is also paying down your mortgage. So that's where I've pivoted to buying and holding, because I'm looking for long-term retirement benefit type of stuff. So I definitely think it's really personal on what your goals are. Like I said, it's not for everyone, but it all depends on where you're trying to go with real estate investing.
Okay.
And is this a question that you ask like new time investors that maybe approach you like, hey, I'm looking to get financing, I'm a new investor. Do you ever dive into kind of understanding what their goals are to really see what direction?
Absolutely. Yeah. I don't want people to feel, I don't want the product to be like something that you need. It's something that you want, and I don't want it to feel like, real estate investing is already a big, huge goal for people. It shouldn't be frustrating and overwhelming. So I definitely try to figure out what is the best goal for you. Like when people ask us about, cash out refinances, what is your reason for a cash out refi? Are you looking to just get quick cash to move on to your next project? And you're going to still sell this project because it's on the market and you're still trying to flip it? Or is your whole intent to actually keep it as a rental and wait until it seasons and equity builds on it? So, I don't want you to just pull cash out just because you feel that bills are, starting to pile up and you need the cash out as quick as possible. I want to know what your needs are actually. So I do ask a lot of questions to make sure that we're offering the right product.
So I wanted to ask you if you can let our audience know, what is the difference with hard money lending versus traditional finance? Because most people out there just know about FHA and conventional loan and going out to the bank and getting a personal loan. So can you tell us about the
Absolutely.
difference?
So traditional lending, in my opinion, is more for someone who's looking for their first time home. Something that you're going to purchase and have your family. Something that you're looking personally for as your long term goal to live in. Hard money is made more for investors who are trying to build their portfolio, flip homes, build a home, and so forth, that they may sell or turn into a rental. And the differences are, with hard money, we don't go off of debt to income. So basically what that means is that we don't need to know what your debt is and what your income is, because we don't value, or we don't our products don't essentially go based off of your debt. It goes off of, we're called an asset-based company. So that means that we're going off of either the cash flow or what the property will become, or the value will become after the rehab is done. So essentially, when you're getting a loan from us, we're looking at your credit score, and then we're looking, do you have the means for the down payment? And do you have real estate experience? So those are the three things that we're looking at in order to qualify you for a loan. In my mind and in my opinion, it's a lot easier to obtain these types of loans, because we aren't saying, okay, well, you only make 50,000 a year and your debt is, 40,000 a year. So we can qualify you for an amount based on what you owe and what you make. We're saying, okay, well, the house is worth right now 150,000. If you put in 30 to 40,000, it will become 350. So we kind of look at different variables and how to lend to you. And then also with hard money loans, and going back to your question as to whether they're made for the terms are usually a lot a lot smaller. So you're looking at 12-month terms. And what this allows you, what they're essentially made for is to purchase the home, rehab the home, and then figure out what your exit strategy is. Are you going to sell the home, or are you going to go ahead and refinance it into what's called a DSCR loan, which is what is calculated based on your income and what your tenant will be paying. So those are options on what type, and that can be a 30-year fixed loan. And these loans are also based on the income and not on your debt to income ratios. It's based on what you're projected to make on this property each month.
Okay.
With the DSCR loans, have you ever had a client use a DSCR for their own homestead?
Yes. Technically, we don't allow, so our type of lending doesn't allow you to do any primary resident loans, but I do know of some cases where, they have refinanced the loan in intentions of it being a tenant occupied home. And, that plans changed.
Right. Yeah, it happens.
Yeah, it happens.
So there's
You
some more
fall in love with the
crowds.
house and you're like, you remodel it and it's so beautiful and you're like, oh, I kind of want to keep it now.
Yeah. Or in cases where maybe like in a flip scenario, I could kind of talk about the one that I refinanced with you last year. We weren't able to sell it in our 12-month original hard money loan. So we had to refinance that into a DSCR, but I don't think it was a DSCR because it was only a 12-month
Yep.
term. So how come it was different?
So in that case, if you're not, so again, it depends on what your exit strategy is. Are you going to put it back on the market because you want to sell it? Or do you want to just cash out and maybe think about it? There's so many different scenarios with this type of lending. So it all depends. If you're going to, if you know 100% sure that you're going to go ahead and get a DSCR loan, then you would go into a 30-year fixed. If you're kind of on the fence where you're like, I need to cash out, I need some money for my next project, but I don't know exactly what I'm going to do, that's where I would probably recommend going into another 12-month term. Because then it allows you to get out of it with no prepayment penalty and you're not stuck with, having to pay a penalty to get out of it. With a 12-month term loan, it's a lot more safe because there's no penalty for exiting. So that's kind of when people are on the fence and they just need cash, or it's on the market and it's taking a little longer and for a fact that you might need more than 3 months, because we do offer 3-month extensions on our loans. But essentially you're paying 1% to extend your loan for 3 months. Or you can pay 1% and refinance your loan for another 12 months. So it all depends on what that main goal is for that property.
Right. And what are you seeing in the market today in terms of clients having to refinance their flip because the term has came up? What's going on with your borrowers?
Well, right now it's kind of uncertain on a lot of different things that are happening in our country. So I've been definitely seeing a lot of people move more towards a DSCR. That way they can keep it for a little longer. The market has shifted. We lend in 46 states. So, and not all 46 states are finding the same struggles as some other markets. But most markets are seeing, a reduction in value and so forth. But one thing to know is that renters are always going to need somewhere to live. So, and you're always most of the time going to be able to find a renter. So I think the DSCR is a great way to offset that when it does happen, because you can definitely, like, it's happened to me. We actually did this in Anchorage, Alaska, where we had to pivot last minute. It wasn't moving. It wasn't selling. We know for a fact that we could have got 430,000 for this home. And we went a little overboard on our rehab because we actually ended up having to do the roof when we weren't anticipating. That cost us an extra 15,000. So our proceeds were not where we thought or projected it was going to be. So we were like, okay, well, what do we do? Like the market is down right now. It's winter in Alaska, so it's definitely slower. Things move a lot slower there. So we refinanced into a DSCR because it's in a great area, close to the hospital, easy to rent. The rental amount is insane in our Anchorage. And now we cash flow almost $500 a month off of this deal.
Nice.
So it's just a matter of knowing your numbers and seeing what is going to be more beneficial, what's going to work best for you.
Okay. And can you explain, because most people out there, they know that when you refinance it's to get a better interest rate, and usually it's for their home. So what's the difference for an investor who's doing a cash out refi?
So I'm not big on cash out refis.
Why?
And the reason for that is I always like to keep cash in a property just in case. I mean, you just never know unless you're not maxing it out. So our max cash out would be at 75% loan to value, which means you can take out 75% up to 75% of the value of the home. I don't essentially I'm more of a 65% loan to value person. And for me, that's just, it helps me feel better about knowing if for some reason the market were to turn, I still have a cushion there that I could use later. But some people are, they're, I don't know if you guys know of what the BRRRR strategy is, but basically it's, you buy, you rehab, you remodel, you refinance, you repeat. So basically a lot of people will go in, take out their money that they invested and repeat the same process over and over again. I do believe in it very highly, but I definitely, for me, my opinion, I like to suggest not maxing out your cash out if you don't have to. But yeah, it allows, sorry, what was the question again? I went off topic a little bit.
No,
It's
you're
okay.
good.
It's okay. So just the difference between what a cash out refi is versus a refinance.
Okay, yeah. Yeah, so a cash out refi is just basically taking out equity of your home. A regular, what's called a rate term refi, is just refinancing the value of the home or the unpaid balance of the loan, and not cashing out anything. So you got to think when you do cash out, you take about a quarter of a point hit. And what that means is the rate increases by at least 25% to take out cash. So that's why I say keep your interest rates low, keep your loan to value low, and make that money up in the cash flow of everything. But like everybody has their own personal strategies as to what's working for them. So, but yeah, I think it's great that there is that option because there's a lot, like I just did a cash out refi. They came in with 40% loan to value and then they cashed out 55% loan to value. So they only took out, their loan was only at 40% and then they maxed it out at 55%. So they still kept it low enough. Sorry, this is the time that my phone just goes off. So they kept it low enough that, it still made sense. They were still cash flowing. They still had equity in the property. So your rate also works where it depends on what the loan to value is. So the lower the loan to value is, that means you're cash flowing more and your rate is going to be better. So what goes into a rate for a DSCR is your loan to value. So how much you owe on the property, how much you're cash flowing, and then whether or not it is a cash out or a rate term refi. So those all affect the rate.
Okay. And the rates are also pretty different with hard money loans and traditional financing.
Yeah.
They're a little higher.
Yeah. Well, so with DSCR, our floor rate is actually 5.75, which is not bad. I mean, for people that we quote in a day, we probably quote anyone around 70 to 75% loan to value, like mid sixes. I should say low to six, high, and to middle six, depending on your credit score. But that's typically what we quote all day long.
And that's DSCR, right?
That's for DSCR.
And that's the same as conventional rates these days.
Yes,
which is
that's
great.
why I'm like, utilize it, build your portfolio. And, later on in 10, 15 years, if all of your properties, say for instance, you have 3 properties and all of them grow by at least $50,000 in equity, I mean, some even more in different markets, now you have like 150,000 sitting there in a little bank account, you know? So that's how I look at real estate is it's a bank account that's just sitting there. Not only are they a good tax deduction, but you know, most of the time if you're also cash flowing, so if you're cash flowing $200 a month off each property, that's also money in your pocket that you can, you know, you can use monthly, and your renters are paying down your principal. So, you know, it works in so many different ways. So I'm trying to teach this to my kids right now, and I think they're getting it. Who knows? Yeah.
I thought it was interesting how you say with your cash out refis, you usually take 60 to 65% of the value, right?
Yep.
I think for most people, they want to take the max out
Yes.
so that they can put it into the other project. And so I kind of wanted to get into that a little bit more. You're saying that it's beneficial to take out less if you can. That way, in a year or 2 years or whatever that looks like, that property still has equity, right? You didn't pull all the
Yep.
equity out.
Yep. And then your interest rate will be lower as well. So if you're under 70% loan to value, you're at one of the best rates. Once you get up to 75%, you definitely take a huge hit to the rate because the way banks look at it as it's a bigger risk the more money you take out on a property, because if the market was to shift and your property is now worth, you know, 20,000 than it was last year, then now you don't have that much equity anymore. So, and in a sense, if you look at it long term, in 10, 15 years, I just like to go with the 10-year rule. In 10 years, that property will increase. It may not increase as fast as you want it to, but in some markets, I mean, so just to kind of give you an idea, my long-term rental in Washington, I bought it. I left. I moved to Alaska. Realized I made a mistake by selling my primary residence because I was like, why? Why did I sell my primary residence? So as soon as we moved to Alaska, I was like, okay, hold on. I need to reinvest in Washington again. So I grabbed the property. It's a 4-bedroom, 3-bath home. I paid $330 for it. It appraises now at $575.
Mhm.
And this is at 2020. So this is maybe 6 years ago.
Wow.
So it's already increased from
Almost
330
double,
to
almost.
575.
Yeah.
Yeah. So it's like it just sits there. My renters are great. I cash flow on that one. So it's like I'm never going to touch it.
Yeah.
But that's how I look at real estate is, you know, you never know where it's going to hit or what markets are going to just boom. So as long as you're cash flowing on a property, just cash flow on it. Like if you don't need that cash out, then just keep it there.
So you haven't refinanced that one?
Nope. No.
Oh,
Yeah.
okay.
I just let my renters keep on paying it down.
Yeah. Okay.
Yeah, I think I owe like under 300 now on it. So
Mhm.
yeah.
So at any point, if like you needed the money for
I
that for
just sell
another
it.
house or whatever
Yep.
personal reasons, you could refinance and pull.
Yep, I could sell it, I could refinance
majority
it and
of it.
pull out cash if I wanted to. I could take a HELOC out on it. There's so many different ways to use the equity on your homes.
Yeah.
And so ground up construction, so you do loans on that.
Yes.
What are all the type of projects that you loan on?
So we do bridge with rehab. So basically that's just your normal purchase with your rehab budget. And then we do transactional loans as well. So people that are looking to acquire a property and then maybe do it and convert it to a DSCR later, or some wholesalers will use it to pick it up and then resell it to do a hotel. So that's a transactional. We do multifamily. We do multifamily ground up, DSCR up to 12 units. And then we also do rehabs. So in Austin, we've done an apartment complex purchase, and they did a condo conversion. So they purchased an apartment complex, and then they rehabbed every single one of the units and then sold them off as condos. So that's called a condo conversion. We do ground up construction. We're doing like a big, huge actually 400 acres in Hawaii right now. So they just acquired the property. They're subdividing everything, and then we're gonna do in phases 100 homes each year. So we do a lot of stuff. Mainly, I mean, I like to keep it super simple, and I like to do bridge and rehabs. Like those are my jam, and I feel like we do really good. But ground up construction is definitely I'm known in Hawaii a lot for ground up construction. We fund probably about 5 ground up constructions a month.
Oh,
So
wow.
yeah, yeah, and some of them are a little tedious, especially ones in Washington. So Washington has a whole dadu thing where they have a property, and the city of Seattle actually approves to add detached ADUs.
Hmm.
So we fund the ADUs on them. So they get pretty creative, because what happens is after they build the ADU, they economize it. So they sell the single family home, and then they sell the ADU as 2 separate entities. So
Yeah, that does
yeah,
not happen here.
no,
No.
no,
I've seen it
it's
in other markets though.
yeah, yeah,
Yeah.
but it's great because, it's like, well, right now we're working on a 3rd ADU in Seattle. So there's already 2 structures. There's a main house, and then Seattle approved 1 dadu, 1 detached ADU, and then now we're doing another ground up construction on the new ADU. So yeah, it gets a little
Yeah.
yeah.
But they're creating opportunities. Like there's
Yes,
people that normally wouldn't be able to own a regular
100%.
family home, and
Yep.
that fits their budget.
Yep, and especially in Seattle. So Seattle, your typical average price of a home, so a single family home for a 3-bedroom, 2-bath, you're looking at about, 7 to 800,000.
Hmm.
You can buy a dadu, so you're looking at maybe 1,200 square feet, a lot smaller of a yard, but it's okay, for people that are looking for low maintenance. But you can buy one for 500,000 and still be within close distance to the metro city. So it definitely gives people that opportunity to still, be closer to work if they work in downtown, and afford, something that's not super crazy,
Yeah.
200,000 more.
Yeah.
But yeah, it's I think it's a great thing, and I think the city of Tacoma now is past a dadu, as long as like your lot is like 8,000 square feet or something like that,
Mhm.
you can build one.
That's so interesting.
Yeah,
Awesome.
yeah.
And so with the new constructions that you do, and you just mentioned that you loaned on an apartment complex project,
Mhm.
what's the biggest loan that y'all are able to do?
So I mean, we go up to like $5 million, but with other options and other exceptions, if the numbers make sense, our company will definitely look at it. I think our most we've done on our team is like 3 million. But there's other loan officers with Conventus that are doing bigger projects because they're in California. Our main office headquarters is in San Francisco, so everything's expensive there.
Yeah.
Mhm.
But yeah, I think some of our loan officers have done like 8 to $10 million
Okay.
projects on ground up construction.
Ground up construction, is that still 12-month terms? I mean,
No,
it's
so
different.
basically it depends on what kind of ground up construction you're looking at. So like if you're doing like a neighborhood for say for instance you're doing like 12 single family homes, then what they'll do is they'll do it in phases. And so usually 4 phases is good depending on how quickly you're building your single family homes. If you're doing just maybe 2 homes, then I'd probably say do like an 18 or 24 month, because we can go up to 24 months.
Okay.
So depending on what state you're into and how quickly permits take, then I also depending on, that if you have permits in hand. So say for instance, you already own the piece of land, and you're going to have permits in hand within 3 months, then a good way to do it would just be go into a 12-month term, unless you feel that you're going to hold on to it for a while because it's going to sit on the market. I always like saying safe. If you do 18 months, then you're kind of at that sweet spot. 24 months is for something larger, like if you're
Yeah.
doing like a triplex or a fourplex or something like
Mhm.
that. and permits might take a little longer, like 4 to 5 months. So yeah, we definitely we have the flexibility to make it work for whatever the project is, whatever the length of the project is going to be for.
Okay. So you said phases and 12 houses. So you mean you lend for developments?
Yes.
Okay.
Yep. Yep. And so like this one, the 400 acres in Hawaii,
Mhm.
they're going to do it in 4 phases. So they're doing 100 each year. So what we're going to do is more than likely something like that would be structured where you go ahead and you lend a bulk on the first 100, or say for instance they were only going to do 50 at a time. You would lend on the 50 builds, and then you go ahead and refinance it as you get closer to finishing that first term. So yeah. And by that time, it's like usually you'll have, it all depends on, I like to know timelines more than anything, especially with developments like this. If you think each house is going to be, so in Hawaii, the Big Island, it's probably taking about 3 to 4 months to build a single family home there. And that's after your permits and stuff like that. So you might have 3 months for permitting, 3 to 4 months build, you're at 7 months, and then you have enough time to sell within 12 months. But if you're doing it at a higher scale and it's going to take you maybe 6 months to build or 8 months to build, and you're doing them in 3 unit increments or 10 units increments, then it might be safer to do 24 months.
Mhm.
So
Okay.
it's all about timing.
Yeah.
Interesting.
Yeah.
Okay. And in all the lending that you've done, the different types of lending, what would you say would be the ideal client that you would want to work with?
I mean, I work with anyone. I like to see, I even work with people who have no experience, because I actually have a few of my investors that I worked with from their very first project, and they're now like, at 20 to 30 projects now. And it's just nice to see the increase and the motivation and the hustle that they put into everything to build their portfolio. So I like to see everything. But if you're talking ideal, like quick, I mean, I probably the best borrower out of any type of experience is someone that gets us what we need as fast as we can, communicates with us, because then it allows us to do our job quickly.
Mhm.
And because we work fast, we like to, we're kind of like, can we get this? Can we get this? Can we get this? We like to do it as we want to make sure we meet our deadlines when we have a closing date. That is what we're trying to make as our closing date. So, in other aspects, I mean, a great credit score is good. Real estate experience is good. I mean, we can definitely close quicker with someone who has more real estate experience. One, because we can get exceptions made for these borrowers that we can't for a brand new borrower, because they've already showed that they can enter and exit projects in a timely manner. So we can get like a drive-by approved. So say for instance, we can't have access to a property. We can get like a drive-by approved with interior pictures or video.
Okay.
So it creates a little bit more leniency. When we have a brand new borrower, we have nothing to gauge off of, because again, we don't go off of your debt to income ratios. We don't go off. We go primarily based off of your experience. Your experience tells us how quickly you can exit projects.
Yeah.
So the quicker you exit projects, the more comfortable we feel lending to you. And then people obviously with that great credit score, because it speaks highly of their payment histories, or how, if they have things maxed out, like we don't gauge our lending off of your debt, but your credit score will tell us things like
Mhm.
because usually if you pay everything on time but you have you max things out, your credit score will change based on your leverages on your debt and so forth. So
Mhm.
Okay.
there's a lot of different factors, but I mean, honestly, the best borrower is somebody who's just responsive and easy to work with, super nice. I like super nice people, nobody yelling at me. Um, because it does by all means, like our goal is to close on time. Everyone relies on us. You title and escrow, buyers, agents, sellers. And so we want to make everyone happy. So behind the doors, we are working our butts off to get a loan closed on time. And so someone who's like just, gets us what we want and is cool and easy to work with, that's like the ideal person.
We try to only give you those types of people.
Yes, and it works. It works.
I was gonna ask too, so with the new investors that have ever came to you, what's maybe like a horror story you've seen or just like easy mistakes also that you've seen them go through?
Like the best feedback I could give for a brand new investor is definitely take time to don't get too rushed into it. Make sure your numbers are working. Get second, third opinions on everything, your contractors, your value, your ARVs, your after repair values. Like really know your numbers going into everything. And don't underestimate the rehab. Overestimate. Like, some people are like, it's only going to be 20,000. I'm like, that is not 20,000 rehab. That's definitely more of like a 40,000 rehab. But they, a lot of investors will get into this saying, no, 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 my contractor, the one person that looked at the house said it's only going to be 20,000. And in their mind, they want to go with the cheapest option. And I'm like, cheapest is not always better because the cheaper option might run you more money later, during inspection or whatnot. So I definitely say know your numbers. If you don't have a mentor to work with, definitely get help with a mentor. Like, a lot of them are like, oh, I've seen it done before. Or I listen to all these podcasts and or I watch, HGTV. I'm like, no, like really get to know, get to know a network of other people who are doing the same things. Get a mentor, spend the money, like invest in yourself. I think it definitely helps in the long run and how to understand. I have made so many mistakes. Had I known the things that I know now that I knew before, but that's also the biggest way to learn things is to make those mistakes. But if you can save yourself from making those mistakes, then that might be an easier way to do that. And then also finding a good team, I think, is definitely probably the top of everything. Partner up if you have to. Like a lot of investors will think, well, I want to make the most amount of money on my first flip. We all want to make the most amount of money on our first flip, but sometimes just, not having all of your capital in one, like just partnering up with someone, go 50-50 with somebody and kind of feel it out. I say for the first 3 to 4 or 2 to 3 projects, like feel it out, work with a partner. I worked with a partner on my first 5 deals.
Yeah.
Just because I was like, one, I didn't want to be without money because I was a single mom. I was like, I am not going to be broke. I can't be broke. And then 2, just because it allowed me to work on multiple properties at the same time. But yeah, you don't try to just learn everything in your first flip because it's impossible to learn everything in your first flip. But yeah, definitely partner up, have a good team. Your contractors are going to be the number one key to everything. Well, actually, your real estate agent is going to be close to your contractor because your real estate agent is going to help you with knowing if you're buying the property at a right price and if you're selling the property at a right price. And then your contractors are going to be golden because they are going to be the ones that are either going to make or break the deal.
And how are you guys able to see if this investor is bringing a reliable contractor? I mean, there's no
We don't
real
gauge
way,
that.
right? Yeah.
So, I mean, if it's a brand new investor, we might ask to see some of their GC's past history, maybe some projects that they've completed before. Especially, but the only time we ever flag these things is if we're trying to make some kind of exception for credit or something, but we do not do any due diligence. I mean, that's why I'm saying it is very, very important that you get the right team together. And then that way, everyone will be happy. There's a lot of really good contractors out there, and there's a lot of really bad contractors out there.
Mhm. With your experience flipping, are you still flipping in this market these days, or have you scaled back on that and only focus on rentals?
So, with my schedule now, the last flip I did was in Alaska, and that was 8 months ago. And I worked with a partner on that because there's no way we can, but now my partner wants to invest in something in Texas. My Alaska partner wants to invest in something in Texas. So she's been hounding me on finding a project. And I'm like, okay, I'll get to it. But my biggest thing right now, so I'm doing a ground up construction in Canyon Lake for it's going to be a duplex. So it's going to be like one side is going to be a midterm, short term, and the other one's going to be a long term, just so I can kind of make sure I have funds coming in for sure every month. And then the other one's just going to kind of be something that I can make, money off of. Because obviously short terms and midterms make more money, but I don't want to take the chance of not getting a foundation of having a full of a long-term renter in there.
Yeah.
So I'm doing a ground up construction, and then I'm really looking to buy and hold right now. I'm on this really crazy thing on midterms right now. Our midterm makes like it just goes. It makes so much money. So what a midterm is it's under 30 days, or greater than 30 days and under a year.
Mhm.
So these are the people you're going to attract, like traveling nurses, business people, people that are like not wanting to actually sign a year lease agreement, but is going to be there greater than 30 days.
Mhm.
And usually these units are furnished. But I like pivoting between a short term and a midterm if I can. But depending on what my schedule looks like too, midterms just make more sense. Yeah, so I try to buy things. I kick myself in the butt for saying this because I am so much of a person that believes in rehabbing and having equity in a property. But my personal time right now in my little space doesn't allow me to go and manage a project right now. So I'm looking for more turnkey that I can do midterms
Mhm.
with. So
Mhm.
that's kind of where I'm at now because the interest rates right now with DSCR are amazing. And the thing about it is real estate is actually cheaper than it was last year in most markets.
Mhm.
So if you're buying low right now, and as interest rates shoot back down whenever they're supposed to go down, as everyone's been talking about, I'm just
For 4
waiting.
years.
Yeah, yeah. So as soon as the interest rates actually do go down, what's going to happen is the same thing that always happens is you're going to have this flurry of people trying to put in multiple offers, which is going to drive the prices back up again.
Mhm.
So if you're buying now while the market is lower, then essentially you're walking in with more equity later in the future when, prices do go back up again
Yeah.
and interest rates go back down. So I'm just trying to be proactive that way and trying to buy while it's lower versus buying. Like the interest rates aren't going down anytime soon.
Mhm.
So, but once they do, then the values go back up. It's like, it goes back and forth all the time. So
Yeah.
buy when it's low, and then you can refinance into a lower interest rate later. Because I'd rather buy something $20,000 less than $20,000 more.
Yeah. This is probably why we work so well together because you have the same point of view on a lot of things related to investment properties that we do
Yeah.
too.
And so right now, because you mentioned the markets better this year,
Mhm.
what are the markets that you recommend investing in? Because you're active in different states.
So I don't really feel that there is a specific market to really invest in. I think what I like to look at are properties that are in better areas. I'm not necessarily saying like school districts or anything. I mean, there's a lot of people for long-term, for primary residents and stuff that are looking, for better school districts and stuff like that. The way I look at properties is I look at where are my hospitals, where are my colleges, where can I pivot if I need to? And the reason why I say that is, can I do a long term? Can I do a short term? And can I do a midterm? Like, can I have all of those options just in case I can't make one way work?
Mhm.
And then someplace, and most of the time, if you're already buying a property that's near a college, near a hospital, near an airport or whatnot, you're going to have an easy time reselling it later regardless, because those are some things that most people look for other than, school districts. So yeah, I definitely try to buy in areas where I know that I can rent easy and then I can sell easy. But I think that speaks for every market, because every market has your pockets. Like in Hawaii, we do a lot of loans, and there's definitely, better areas to invest in versus, ones that I probably, even if the house was like 300,000, I don't know. So yeah, I think just knowing your areas, and like with Austin right now, I don't really care for the Austin metro area if I'm trying to gear towards just one type of buyer or renter.
Mhm.
So I like San Marcos, because they have the college, they have, it's in between both, Austin and San Antonio. You have the park, the water park. You have so many different options in that area, the outlets, whatnot. I like Round Rock really a lot because it's not too far from the airport. It's not too far from Austin, but there's a lot of hospitals in that area between Round Rock and Cedar Park. So yeah, just and follow the Costco's. Wherever
That's
Costco
perfect.
starts like opening, that's where you want to buy, because Costco does so much research into where to put their warehouses that you already know that that's going to be the next area. So I follow Costco's too.
We need to find that CEO's number so we can ask him where he's building that.
Where's the next one?
And so you mentioned the different areas to look in for what would be a potentially good deal or good investment, and the types of rates that you look into.
Mhm.
What would you consider to be a red flag, like a project that you just would not loan to?
Mm, you know, well, what we won't loan. So we won't really loan on. So, I mean, we do rule. There are some areas like, I think we did a loan in Ohio recently, and our team was like, no, that's just not good dynamics. Like, there wasn't, it was a higher crime area. And so our team was like, we don't really want to do loans in that area. And I
Mm.
know nothing about
Interesting.
Ohio. So I was just like, why?
Yeah.
We can do this loan. But it made sense later after I did some research on it.
Mhm.
And so yeah, definitely I know that we won't lend on any manufactured homes. Even though they're attached to a piece of land or anything, the value of those tend to decrease in value than to increase later. So we try to do stick built. And yeah, I think I've never really got turned down for loans. I think it just happens to be in low population. I mean, like I think somebody asked me for a loan, and the population was like 800. I was like, and there was nothing nearby. There was no major city that I could find within like, I don't even know, 100 miles. I
Oh,
was like,
boy.
who's gonna buy this property when it goes back on the market? But they were like, but it's on 27 acres. I'm like,
Uh-huh.
that's what I mean. Who's gonna buy it
Yeah.
after? Like they're away from all of the things you need. I don't even think Amazon goes out there. But
So
yeah.
not rural and not Ohio.
Yeah.
Okay.
Yeah. Ohio. I have to see what zip code it was. But yeah, the team was like, no. And I was like, what do you mean? Why can't we do this? they're like, do some research and then like find out. And then I looked at it, I was like, yeah, there was like it was super high crime area. So
Yeah.
I try to do loans that I'm familiar with, or I have a little bit of an idea
Mhm.
about. We lend in 46 states, but primarily the states that I focus on are Hawaii, Alaska, Texas, and then some of Washington. Because I was a real estate agent in Washington for 20 years, so I know a lot about the real estate there. But yeah, I try to stick to what I know. But yeah, there's definitely high crime rate in some areas of Ohio.
And it's funny that you say that because as agents, if a client asks us who's trying to buy a homestead, oh, what's the crime rate here and what's the best school district? And if we give them an answer, it's considered steering.
Yes.
Um, we can't do that. But with an investor, we do have to because
Yes.
we're watching out for their money. It's a different sort of transaction. So we
Mhm.
do have to look into the crime rates and what sort of
Yep.
neighbors do you have and is it considered to be in this school district versus not?
Yep. Yep. And I
Interesting.
feel like that's what I like working because I was a real estate agent for a long time. And I definitely give you guys props because it's easier, I feel. Well, investors can be a little bit more focused and hands on because you are dealing with, you're not dealing with just their primary residence. Most of the time, you're dealing with multiple projects and you have to oversee maybe some of their project management, and you have to, most likely you're probably going to list the property after. And so you have a lot more to deal with them rather than I bought you a house and I'm going to just, send you a card once a year and we're going to stay in touch. Investors are very much an entirely different atmosphere, but it's also really fun because you can be so much more raw with investors. You can tell them, hey, don't buy that. Like,
Yeah.
like that is like, but it's hard to tell somebody who's like looking at their primary residence, like, oh my God, I could see my babies growing up here. And I'm like, you can't tell them like, no, I mean,
Yeah.
you can give your opinion, but with investors, you can tell them, I don't think this is a good idea, this, and this, and there's, some strange, like,
I just saw a hooker walk by. Let's
yeah,
not go here.
exactly. You can tell them those kind of things and they'll usually most of the time, 90% of the time, they'll be like, you're right. Okay, let's look for something else.
Yeah.
With someone who's looking for a home, they're like, but why?
It's so
I
cute.
fell in love with it when I first walked into it. And you're like, but didn't you see that guy on the corner? Like, that doesn't bother you? Oh, we can live with that. I'm like, oh, okay. Then 5 years later, they want to sell their house and they can't sell it because the same guy is at the corner, doing whatever he's doing
With friends now.
So
yes, there. So I feel like it's definitely an easier sell in some aspects, not all aspects. I
Yeah.
think it's harder in a lot of things, but I think it's also more exciting working with investors too, because you get to kind of see the transformations. I'm like one that like stalk people when they're done with the project, and I'm like, ooh,
Or
Yeah.
yeah, or ooh,
Yeah.
why did they keep that? I was actually just looking at one, and I was like, why? Why didn't they take that out? But I mean, but it's nice to see everybody's personal touches to stuff. So,
Yeah.
um, but yeah.
When you were an agent, did you work with investors at the time at
Not at
all?
first.
Okay.
Yeah. When I started, I was working with first home time buyers. I did a lot of that for a long time. And, I think my worst one, I probably showed this couple like 40 homes. I swear we looked at so many homes. And then it turned out that their engagement broke off and that they were both moving to two different states. They weren't going to stay in Washington anymore after 40 houses. And I was like, oh my gosh, okay. And this is probably over a course of like a year. So you look at all that invested time and money and you're just like, your heart just breaks because you're like, oh my gosh, okay, I probably spent like a few $1,000s in trying to make this work. And it just, some things are just unfortunate, you know, and it just doesn't come out to everything. But as soon as I left that world, I was like, this is so much nicer. But then I started working with investors, first finding rental properties and stuff like that. A lot of them would, you know, ask me. So I knew the rental market really well. And then it kind of shifted to, well, why don't you buy fixers and rent it up, fix it up to what you want it, and then, you know, rent it out. And then it kind of migrated to, okay, why don't you, you know, rent it out as a short term, you know, or, you know, and then I started just working with a whole bunch of investors looking for stuff. And then I was flipping up my, or actually I started actually working with my other partner in Washington. We started actually fixing up homes the way our buyers wanted them to. So we would find um, a rehab project, and they're like, okay, well, we want to you know, paint it this color. We want this color flooring. We want this, and this. And essentially we sold it to them. So we would buy it, we would remodel it, and then we would resell it to them how they wanted it. So they would pick out the property that they wanted, and then we would make it to what they wanted it to be, and then we would go ahead and sell it to them.
Wow.
Yeah. So it's kind of like you have a personal, not a new build, but a
Yes.
personal, you know, a brand new customized home. Everything's done. The roof is done, you know, and then you're getting full value for this house. And then you already have a secured buyer.
Yeah.
So,
Right.
you know, in a sense, it worked out great because, you know, they were already
Yeah.
pre-approved to begin with. It's just, we just made the house the way they wanted it to be.
Mm-hmm.
So we started doing that as well. We've been through so many different, you know, loops, and you know, wherever the market has pivoted, we've kind of adjusted.
Yeah.
But what I'm doing right now is probably I enjoy probably the most. I don't have to, like, you know, work with showing people
Yeah.
houses. And you know, I mean, I don't have my own schedule, but I can have my own schedule if I wanted to. When you're showing homes, you're kind of at the mercy of when their availability
they're
is.
available.
Yeah. Yeah.
It's funny that you say that because there's a Netflix show right now that's just like that.
Yeah.
About selling them the distressed home and then you fix it for them.
Yes.
Yeah.
Yes.
And I thought,
So
that
we got
sounds
that
like
idea
fun.
when we first started that from Fixer Upper.
Mhm.
And then so we were like, well, why don't we just do something like that, you know, where we're just kind of like selling them the house the way, you know, they want it,
Yeah.
you know, and they're picking out whatever. Minus the Fixer Upper, they do like way more, you know, remodeling, and our buyers weren't, you know, in the means of coughing up like 150, 200 in rehab.
Right.
So, you know, we try to keep it still at a good purchase price, and then put in like about a 50,000 rehab. But yeah, it worked great. You know, the buyers were happy because, you know, they picked out the house in the area that they wanted, and then they picked out all their colors and everything. So, and then we were happy because, you know, we didn't have to go through, you know, listing it and,
Yeah.
you know, selling it, waiting for it to move off the market. We already had a buyer in hand. So
Yeah.
Making the investor and home buyer's dream come true.
exactly. Exactly.
Contact
I think
us.
this is great. Like I really we didn't know a lot of this background about you. And so you having all types of experience is like where your value comes from too, with investors coming to work with you because you've gone through it, or you know
Mhm.
different strategies that you can suggest to them, like midterm, short term, all the things. So
Yeah.
the value you bring to investors is amazing. And we're very lucky to work with you.
Yes.
As we wrap it up, do you want to share with the audience goals you have for this year?
The goals. Yes. Okay. So, well, I have personal and professional goals. So last year we closed, as a team, we closed 256 loans. So our goal is to close at least 300 loans.
Okay.
So that it's definitely up quite a bit, but I
Mhm.
feel like we're on target right now.
Awesome.
And then personal goals is to actually just take vacations and, you know, kind of like reflect. And, you know, I'm very big into family, and I'm very big into, you know, like just being grounded. And so I think it's important that you know who you are, because sometimes your stress level and your work environment can definitely take a hold of the person that you are, and sometimes make you into someone that you're very far from knowing. And so I definitely take time for yourself. I think this is definitely a career, and even just in general, I think a lot of people just let negative things get to them. So my goal is to
Mhm.
just not focus on anything negative and just be positive as much as I can.
Yeah. Amen to that.
Yes. All right. Well, thank you so much for joining us today. She
Mhm.
came all the way from Austin to San Antonio.
Yes.
So thank you again. We'll probably invite you back because lending is such a big world. There's so many different types of loans and clients and projects. And
Mhm.
I think that people would really want to know more about how they can be prepared to take on some projects. And
Yeah, absolutely. We can definitely go over scenarios and, just how to start. I think a lot of people get confused on, or just lost on where to start and
Mhm.
how to, I have a lot of good stuff that, we kind of talk about just how to prepare, and just solutions on how to get started, because not everybody knows that. They think that you have to have $1 million in the bank or
Mhm.
whatnot, and there's so many different resources to
Yeah.
get started.
Yeah, there's a lot of misconception out there,
Yes.
but awesome. Thank you guys for tuning in, and if you have any questions or wanna connect with Tam, we'd be happy to connect you guys. See you on the next one.
adios.